Now, the Treasury says the deadline for raising America's borrowing limit is Thursday, and here's what they mean by that. The government borrows 20 cents out of every dollar it owes. When the debt ceiling is reached, the government can't borrow that 20%. Treasury would have to choose which bills to pay and default on the others. It's happened before, once momentarily in the 1970s because of a mistake, and in 1814. When the British set fire to Washington. Hope that history won't be repeating itself sent stock prices higher after a triple-digit decline in early trading. The Dow ended with a gain of 64 points, closing at 15,301. Anthony Mason is our senior business correspondent. Anthony, every day we end the day with no deal. Why is Wall Street optimistic?
I think, Scott, because we've been here before back in 2011. It looked scary, but it turned out okay in the end. But there is evidence the economy is taking a hit. Both Goldman Sachs and Moody's estimate that the uncertainty in Washington, the government furloughs, have cut about a half a percentage point off of our economic growth. And for a country that's only been growing about 2% a year, that's a pretty big hit.
What have Wall Street firms done to prepare for the possibility of default?
Well, Fidelity and JP Morgan both have sold off short-term U.S. government debt. But there has not been a stampede to the exits on U.S. Treasuries. In fact, the sell-off isn't yet as bad as it was 2 years ago, and that, of course, is when the U.S. credit rating was downgraded.
Sounds like near-term pessimism, long-term optimism in the bond market.
If this gets worse, you will see Wall Street scared, but they're not scared yet.
Anthony, thanks very much.